Yo, what is going on, family? I appreciate you guys for actually pressing on this link, for watching this YouTube video, because it says that you either joined this business recently or you've been here for a little bit and want to improve yourself. Now, guys, this video, I'm not going to take too long to talk about. We're going to be covering proper risk management. Now, what is the importance of proper risk management? Well, using proper risk management will, one, help you to not even blow accounts. It's going to help you have low wins and high rewards. It's going to help you identify what trades you should be taking and what trades not to take, as far as understanding your risk to reward ratio. Now, real quick, guys, we're just going to go ahead and hop into this super quickly. Using proper risk management is important, guys. Now, the first thing we need to understand is our lot sizes. Now, on MetaTrader 4, we see a pair right here, AUD/USD. Now, the thing that's important to look at is your lot size. So this is basically the amount of money that you're trading per pip inside of the foreign exchange, the cryptocurrency, the high frequency, or the stock market, the indices. Not so much high frequency forex, to take that back, because that's a different kind of trading, but it still works the same way depending if you're trading binary or not. Anyways, hopping back on the topic, this is essentially your lot size. Now, for very simplification, you could simply just tap right here, pull up your keypad, and then change the amount that you want. Now, the biggest thing is understanding what lot sizes are we using to help us understand how much money we're actually putting inside these markets to then multiply and get a return of our investment. Now, the smallest lot size that we have is going to be right here on the left side. 0.01 is absolutely the smallest lot size that you can ever use. Now, for the majority of brokerage services that we use, Hugo's Way, KOT, FX Choice, Forex, whatever the case might be, this is the smallest lot size, which is 0.01 is equivalent to 10 cents per pip inside the market. So basically think 0.01 is 10 cents. So a 0.02 is 20 cents. A 0.03 is 30 cents. 0.04, 40 cents, 50 cents, 60 cents. 0.07, 70 cents. 0.08, 80 cents. 0.09 is 90 cents. Now, as soon as we go above 0.09, then that's when we go into the dollar. So add 10 cents, because 0.09 is basically 90 cents per pip. Now, if we add 10 cents to 90 cents, that's a dollar. Excuse me, my fault. So sorry. Let's go ahead and put my computer on Do Not Disturb. All right, awesome. Cool. Continuing, guys. So I'm pretty sure that scared you guys. You're like, who's calling me? So 0.09, add 10 cents to that. That's a dollar. So as soon as we go to that dollar, that is the lot size of a 1.10, which is the exact same thing that is located inside of this box right here. 0.10. So a 0.10 is simply $1 per pip. A 0.20 is $2 per pip. Now, you notice how there's a 0.10 and a 0.20? Well, what if it was a 0.11? Then it would simply be that dollar. And then since this second number right here is the cents, 10 cents. Say if it was a 0.12. This is your dollar. This is your 10-cent increments. So this would make it $1.20. Sorry for my bad drawing skills. There's only so much you can do. So guys, super simple. For example, 0.21, 0.32, 0.45. This is the dollar. So that's $2.10. This is the dollar. So that's $3.20. 0.45, give you a couple seconds to guess it, $4.50. Super basic. Now, as soon as you get to a 0.99, which is $9.90, you go into a 1.0. Now, 1.0 is $10 per pip. 2.0, $20 per pip. Now, if the first number, the whole number, is a $10 increment, 3 would then make it 30. This is the dollar, $34. This is the cents, $34.20. $40, $55, $60. Oh, sorry, I right clicked there. $60. Oh, let's take that back. Maybe I can't. Oh, perfect. Cool. $60. 6.0. Now, guys, now that we understand what our lot size is, we need to calculate our risk and reward. We need to understand how much money are we risking and for what profit. Because understanding how much we're risking is going to help us understand what lot size we are going to use depending on the size of our account. Now, guys, if you guys are so grateful to be inside of our Wealth Club group chat, Wealth Club Trade Ideas, we have people like Gustavo, like Jasmine, like my homie, my best friend Alonzo, to actually send us trade signals where they have already invested time into these markets to then tell you what trades to take, to then tell you exactly where to take those trades, how much to risk as far as a pip measurement, and where your area of take profit is going to be. Now, for example, the trade we're going to be focusing on today is going to be right here, guys. This one right here that I'm highlighting. Now, it says right here, EURJPY. It is a sell limit. Now, if you don't know what a limit is, I would really recommend hopping into the education side of the academy, because then that's going to teach you different orders, different positions, sell limits, buy limits, sell stops, and sell stops. Those are some good things to know. Now, guys, right here, SL simply stands for stop loss. It's your safety net inside the market. It tells you as soon as it hits that stop loss, you're outside of the trade. You already took a loss. It didn't go in the direction that you expected it or anticipated it to go into. Now, guys, TP right here stands for take profit. So notice how we have two take profits. We have two levels that we can exit out the market in profit. Now, for today's example, we're going to focus on this stop loss right here and this take profit level right here. Now, Alonzo I'm so grateful that Alonzo already tells us how many pips we're risking and for how many pips we're looking for reward. Now, guys, hopping in right here, our stop loss is minus 14 pips. Now, if we trade that 10 cents, which is a lot size of 0.01, 10 cents per pip, we multiply that by 14 pips. That means our risk is $1.40. 20 cents times 14 pips, it's double $1.40, $2.80. Now, this is not 10 cents anymore. I tricked myself. So we went from 10 cents, 20 cents. You could do 30 cents, 40 cents, 50 cents. Now, for an example, this is a 0.10. If you guys don't remember what a 0.10 is, it is $1 per pip. So if $1 per pip times 14 pips, 1 times 14 is 14. That means our risk is now $14. That means essentially we are okay with losing either $1.40, $2.80, or $14. Now, going back to our take profit level, our take profit level is plus 44. Now, guys, if our take profit 1 is 44, say we use that exact same lot size, 0.01, 10 cents, times 44 pips, that means we risked $1.40 to then gain $4.40. Now say 20 cents. 20 cents, our risk was $2.80. And now our reward, 20 cents times 44 pips, is $8.80. So essentially we risked $2.80 to gain $8.80. Now if we trade at $1 per pip, $1, which is basically 1 times 44 is $44 reward. So basically, we were risking $14 to then gain a potential $44. So hope you guys understood that. I'm gonna go clear this. Now guys, focusing our attention here. Our risk was 14 pips. Our reward was 44 pips. which means our risk to reward ratio was 14 risk to 44 reward. If you simplify that equation, it's 3.14. Any risk to reward ratio that is above 3 is a really good ratio. That is usually what we want to stay around. We want to stay above a 1 to 3 risk to reward ratio, basically meaning our reward is 3 times greater than our risk. Our risk is 3 times less than our reward. We always want our reward to be greater than our risk. Now, guys, for an example, $100 trading account. Most people start off with 100, 200, 250, 500, whatever the case might be, or even $50. Your risk should be anywhere between 3 to 5% of your total account balance per trade. Your reward should be anywhere between 5 to 10% of your total account balance. Not of what you want to trade, but of your total account balance. So meaning we're risking 3 to 5%. Our return is anywhere between 5 to 10%. Now, one trade can take you 10% in profit. So now we're 10% in profit. Now, say we lose 2 trades. So one trade made us 10% in profit. Now, 2 trades, say we risk both trades at 3%. 2 trades times 3%, 6% loss. Now, at first, we were 10% in profit, and we lost 6% of that, which means what? We are 4% in profit. We are still in profit. So technically speaking, guys, you're still in profit 4%. Now, guys, the biggest thing, we were in profit 10%. We lost 6%, which means we were still in profit 4%. The majority of traders see that 6% loss as the end of the world. They lost 6%. They lost $10. They lost $30. They lost $100. Little do they know they're still in profit. So people focus too much on that loss and not enough on the percent that they're still in profit. And the majority of the time, because they focus on that loss, they do something called revenge trading. So we want to avoid revenge trading. Focus on learning from your losses, guys. It is okay every once in a while to take a step back. Observe your trading method, your style of trading. But at the end of the day, don't wait too long. Attack your plan. Right here, guys, another example. We had this trade idea right here. So we had Euro AUD buy. It was a buy-buy market, so it was a market execution. Now, our stop loss is 20 pips. Our take profit is 60 pips, meaning our risk is 20, our profit is 60. Our risk to reward ratio is 1 to 3, which basically equals out to 3. Now, remove this. Cool. Now, since our risk is 3 to 5% and our account balance is $100, meaning our risk at one time is anywhere between $3 to $5. So if we figure out our lot sizes, what lot size are we going to use to only minimize our risk anywhere between $3 to $5? If we use a 0.01 and we multiply this by our stop loss, which is 20 pips, that means our risk is $2. If we do 30 cents per pip and we multiply it by our stop loss, which is 20 pips, to see how much we're risking, that's $6. 10 cents per pip is too little. 30 cents per pip is too much, $6. Our original risk maximum is $5. But 0.02 times 20 pips, which is our stop loss, is $4, which is perfectly in the range for our 3 to 5% stop loss. So now that we identified that 20 cents per pip is the maximum lot size that we're going to use, which means we could also use a 0.01. you know, this is more of a risk less than 3%, but our reward won't be as great. We'll still be in profit, but we also want to maximize our reward and minimize our risk. So that's why it's good to have a risk to reward ratio. Now that we determine our lot size, which is basically our risk, now we know how much we're risking. What is our profit? So 20 cents times our take profit level, which is 60 pips, grants us $12 profit. Now your account, when this trade hits take profit, if it hits take profit, when it hits take profit, whatever the case might be, now that makes us 12% in profit, guys. So by risking 3 to 5%, we came up 12%. Guys, it's really as simple as that. Now, without having to do all this math, guys, there's a super cool app called Stinu. Now, to be frank, I'm not sure if this app is available on the Google Play Store. I'm not sure. I know it's available on the Apple Store, but I'm not sure if it's for Androids. Now with Stinu, it does the math for you. It tells you, hey, what's your account balance? How much are you willing to risk on one trade? What is your stop loss in pips? And then it will give you a range of lot sizes to use, and then telling you what is the amount of money that is risk involved. Now, guys, it's really as simple as that. I really appreciate you for hopping on this video, taking notes. Hopefully, if not, go back, take notes. Download this app ASAP so then we can understand risk to reward management, understand how much we're risking, how much we're profiting, so that then we can take our trading journey to a whole nother level. Other than that, guys, I appreciate you guys, and I hope you guys have an amazing, amazing day. Peace out, guys.